We shall continue with assessment criteria 1.2 on the implications of different sources of finance. What do we mean by implications? For example, the cost of borrowing might be very high if it is variable interest rate or fixed interest rate. The legal implication of finance, we look at the area of risk, legal and dilution of control. Separate legal entity, this is a requirement for limited liability companies. That means this company are separated from individual owners. The owners of the business or company cannot be sued. Therefore, if the business go bankrupt, it is either the creditors sell off the asset of the company or it will turn to a bad debt. The shareholders' liability is limited. The company owns its assets. Capital subscribed by shareholders may only be repaid to them under rules designed to protect the interests of creditors. Let's move on to the other point. We look at partners in terms of the legal implication of partnership. No separate entity, liability for business debt is usually unlimited. Therefore, the partners are liable for the debt of the business. If the business goes bankrupt, for example, you are expected to use your personal money to pay off the outstanding debt to any creditors. The partners jointly own partnership property, so traders own property personally. Owner may, by mutual agreement, withdraw capital as they wish, but unpaid creditors of the business may claim against them personally. This is a very serious legal implication. However, all agreement must be documented to avoid any legal hitch. Owners are entitled to participate in management. A sole trader or partnership may exist without any written partnership agreement. This is another serious legal implication. A partnership must disclose the names of partners, but no one except a partner has the right to inspect account. This is a very good example, the activity on the board, of legal implication of finance. You can look at the cost of borrowing. For example, you have £10,000. You can decide to put the £10,000 in the building society and earn an interest rate of 3%. Alternatively, you can lend it to a friend who says, I will pay you 4% interest rate. Task. What other information would you want before you can decide to lend this money to your friend? In answering that task, it is possible for you to look at the credit profile of your friend, any available asset, their home address, and their contact details. Just in case of default, you can be able to claim your money back. Because the additional interest of £4 we add as cost, repayment cost, to your friend that you borrowed the £10,000 to. Principles applied by the lending banker. So this is a general principle if you want to lend money to anybody. First, you need to look at the character of the borrower. In these situations, and the past credit worthiness of the borrower can be assessed to know or determine if this borrower is credit worthy. The ability to borrow and repay, the margin of profit, the purpose of the loan, the amount of the loan, the repayment terms, insurance against non-payment, which is security. However, there is a legal challenges here at the moment in the UK known as payment protection insurance. Any insurance included in the agreement must be disclosed to avoid any legal challenges. We now move on to assessment criteria or learning outcome number 2. Says analyze the cost of different sources of finance. Analyze the cost of different sources of finance. Finance as a resource has cost, and this cost should be controlled in order to achieve set objectives. Finance costs include cost of borrowing or obtaining finance, cost of managing finance, the fees payable to financial consultant and stock brokers to obtain the finance, the fees payable to mortgage advisors and tax advisors, commissions and interest on capital. All these fees are expected to be paid back to the lenders of the finance. The cost of finance continue. First, there are 4 basic sources of finance examined. We look at the cost of these 4 basic sources of finance: the dividend, borrowed funds, government grant, and retained earnings. Let's look at the cost of these 4 areas of borrowing money. We will use an example to demonstrate how dividend payment can affect or lead to additional costs for a business. The dividend paid in cash example include: if you own 100 shares in ICI Limited, the company will pay you so many pence per share twice a year. If ICI paid dividend of 20 pence in March and September, that means shareholders are paid dividend twice every year. Therefore, the cost of your dividend to ICI will be 100 shares times 20 pence times 2, which will lead to £40. Another cost can be what we call the scrip dividend. Instead of ICI paying you in cash, you are awarded additional new shares with a cost implication. For example, instead of ICI paying you £20 in cash, they offer you 2 new shares plus £4 in cash. The advantage is that company retain more cash, which it can use to develop the business. However, there are costs associated with this, as well as cost of providing financial report, the cost of annual general meetings, the audit fees, the administrative cost, and the additional cost of £4 and the extra 2 new shares given to you by ICI company. The cost implication for borrowed funds can be demonstrated with a very simple example. The cost of interest payment, for example, if you borrowed a loan of £100,000 and paid 10% interest, the cost would be 10,000 divided by year. Okay, therefore, interest rate at this situation might be fixed or variable. Initial arrangement fee to cover lenders' administrative costs will be factored into the loan. Cost of providing lenders with up-to-date business performances will be included as part of the repayment cost. Therefore, the business that borrowed the 100,000 will be paying additional cost. Government grant, which is a very good way of starting up a business or expanding your business, sometimes there are no costs attached to government grant. However, you need to meet administrative costs to cover applying for the grant, such as filing of forms, phone calls, and traveling expenses in some cases to inform the authority about the performance of your business. We look at the last implication of cost implication of finance, retained earnings. In retained earnings, there are costs associated with it, such as the overhead, wages, rent, electricity cost, and materials purchased. Business have to pay tax on their earnings as well. Dividend are a cost of retained profit. Reinvested retained earnings in the short term will incur administrative cost. Let's look at opportunity cost as an example. If a business is to invest £50,000 of retained earning on project A, this will reduce the capital available to alternative projects. You can look at 3.3 assessment criteria that will give you more information about investing in alternative projects or investment appraisal systems. Therefore, if the alternative project is expected to yield a profit of 15%, then the cost of using the finance for project A is the 15% return lost on the best alternative. To ensure the cost of finance is effectively managed, it is important to look after it from day-to-day perspective. That means your day-to-day working capital must be properly managed. The working capital of a business is defined as the current asset less current liability. Current assets include cash, stock, raw materials, inventory, work in progress, finished goods, and amount receivable from debtors. Whereas your current liabilities include creditors payable within 1 year, tax, short-term loans. Now, the big question is, are there sufficient assets to meet your current liabilities? So, your working capital needs to be effectively managed and sufficient to be able to continue in operation on a day-to-day basis. We now move on to 2.2 learning criteria or the assessment criteria, and it says the importance of financial planning. Having discussed the implication of cost for different types of business organizations, it is therefore important for us to look at why financial planning is a good strategic tool used for business purposes. What then is financial planning? Financial planning is the process of determining whether and how a business can achieve business objectives through effective management of financial resources. A business budget is a good example of a financial plan, as it gives us a clue about how to evaluate known variables such as current cash flow, and to forecast future cash flow, sales and asset values. Therefore, organization will be able to have a clear picture of their future financial dealings with the help of the financial plan. Let's look at next slide for the importance of financial planning. Number one, it leads to good management of income, effective monitoring of cash inflow and cash outflow, good use for decision making and safeguard of business assets, help forecast the amount of external borrowing or financing needed for the business, help in business growth and expansion initiatives that support long-term survival of the business. Therefore, financial planning is necessary if a business wants to remain in the environment for a longer period of time. We move on to assessment criteria 2.3, meeting the needs of different information users. The information needs of different decision makers. Who are decision makers to us in the business organization? In other words, they are known as the stakeholders or the users of accounting information. There are two types of users of financial information. They are the internal and the external users. The internal users of financial information, they include the managers of the business, the owners of the business, the employees of the business. The managers of the business want to understand how the resources are being managed. Whereas the external users of financial information, they include the general public or those with a vested interest. The investors or the shareholders, customers, suppliers, communities, local council, the government for tax purposes, regulatory institutions for compliance purposes, investors to be able to make an informed decision whether to invest in your business or not to invest in your business. We have been able to classify them in a tabular form. For example, the internal users for decision-making purposes relating to staffing, investment opportunities, financing, diversification of business, expansion and growth as well. Forecasting purposes, it is needed for debt and liquidity management. Employees' bargaining power, such as wage increase, promotions and other incentives. Employees or the trade unions, they need the financial information of the business in order to champion for wage increase or call for promotions. Why do external users need financial information? Like I said earlier, shareholders should be able to make an informed decisions whether or not to invest or not to invest in the business. The government needs the financial information to ascertain if the business is paying the correct amount of taxation or tax, to assess the financial strength of the company, to understand the liquidity position of the company, for lenders to verify business position in the market, and if resources, financial resources, are efficiently utilized, either for the short term or the long term purposes. We will now move on to 2.4 assessment criteria by looking at the impact of finance on the financial statement. First of all, you need to know or understand assets and liabilities, the implication of asset and liability on a given financial statement. Take for instance the balance sheet. Under the fixed asset or current asset column, if there are not enough assets, that means the business might not be able to finance its liabilities. Therefore, the business requires enough assets to offset liabilities and maintain liquidity. Working capital management, which is current asset less your current liabilities. To ensure current assets such as stocks, inventory, debtors, cash in hand are adequate to meet the daily requirement of finance. Bank overdraft and short-term loans can affect working capital if the business defaults on payment. Long-term debt in terms of loan can as well affect negatively the position of the financial statement if the loan is huge or the company default in interest charge payment. Also, the equity or the owner's capital or debenture capital increases the worth of the balance sheet. Share issues shown in the balance sheet and dividend paid in the amount of profit and loss account after tax. So if the owner's equity is in a good position, it can affect positively the worth of the balance sheet. Therefore, business financial statement must be true and fair, as well as ensure that standards are met. At this point, I will advise all learners to look at the accounting concept as prescribed by the generally acceptable accounting principles or practice. I have provided some of the concept of prudence. Do not overestimate the value of an asset or transaction in the financial statement. Consistency concept. The same principles or method should be used to construct financial statement from time to time, so that decision makers can simply understand the content of your financial statement. Going concern concept. It is believed that the business will remain in operation for a foreseeable future. The accrued concept. Revenue should be recognized when earned and not when paid. Therefore, if you look at the profit and loss account, under the overhead section, it is possible to record your accruals as at when incurred, not when money is paid. The financial statement must be reliable, comparable, and understandable. All items should be clear to users of the financial information. We will now move on, before we take a break, to look at the learning outcome number 3 by analyzing budgets and make appropriate decisions.